Hey, it's Dak Hartsock, ACI Wealth Advisors, Process Portfolios, with a hopefully quick survey about what's happening in the market right now. We're going to talk about the valuation of the S&P 500 today. Kind of work on the question of whether or not it's overvalued or in bubble territory. We saw Trump in the past has said the whole thing's a giant bubble. Some media people are claiming the same thing. So today, going to kind of crack the hood a little bit, take a look at what's happening underneath, and kind of more get the facts rather than just the opinions of people that may or may not know what they're talking about. So for those of you that want to learn a little more about me, I'm Dak Hartsock, dakhartsock.com/about. You can learn more about me if you wish. So what we've got here is a way that a lot of people talk about valuing the market. That's the price earnings ratio. Do things a little different. I use the equal weighted earnings ratio, and that's because it gives me a little bit better visibility into what's happening in different sectors and different companies and things like that. And I think it's maybe a better way to understand what's going on in the market. So let's talk about this graph that we're seeing here. The red line is the average price to equal weighted earnings ratio over the last 10 years. And the blue line is where valuations have been over the last 10 years. And general rule of thumb, this red line, you could also consider it what's called fair value for the S&P 500. If you're below that, the S&P perhaps is a little undervalued. If you're above it, it's overvalued. So what we can see here is the S&P overvalued right now? It absolutely is. Is it in bubble territory? Probably not. This big spike over here where you see the mouse, that's prior to the crash in 2008, and you can see that the price to earnings ratio is considerably higher. If you look back during the dot-com era, you see something similar where valuations ran a lot higher than they currently are. So that's something to keep in mind. Nothing's infallible, but this is a good way to kind of get an idea of whether the market's overvalued or not. Now, is the market overvalued? Yes, it is. So the question then is, well, where is fair value? It's about 20% lower than where we are today. SPY, which is a proxy for the S&P 500, closed at I think about 215 and change today. So that implies that real fair value for the S&P 500 is down around 20%. Now, that being said, price earnings ratios can be useful, but they're not the only way to value the market. And there's some key differences between the S&P valuation now and what we've seen in the past. And that's that central banks are doing all they can to keep economies out of deflation. Contrary to the doomsday newsletters, contrary to some of the comments about what the Fed's been doing, the big risk is deflation. It is not inflation. Inflation can be stopped in a year or two, and we saw that in the 80s. Some of you may remember that. We had very high rates of inflation. The Fed came in and within 2 years basically stopped it. Deflation can last a decade. It can last 2 decades. That's where the fear is. And that's why rates have been low, and that's why rates are going to stay low versus the historical averages for longer than I think anybody really expects. And that helps support stock prices. And it also gives companies a chance to kind of return to earnings growth. We saw earnings growth peak a couple years ago. We've had some falling earnings since late 2014, but we're beginning to see signs that that earnings growth is restarting. And for those of you that follow these things, in January this year, I pretty much said I'm thinking we're going to see earnings growth restart in the second half of the year. And that's kind of what's happening now. But the price earnings ratio is not the only way to value the market and get a sense for what's a good investment and what's not. So let's talk about this method of valuation. This is something used by a lot of big managers. And what you do here is you're kind of comparing the two biggest asset classes, that's stocks and bonds, right, to see where the value is. So an easy way to think about this is the blue line is the 10-year Treasury yield. The red line is the S&P earnings yield. And the difference between the two is called the equity risk premium. That's just the fancy, Wall Street term for I should get paid more to own stocks than bonds because stocks have a little more risk in them, right? And back in January, I also said I think the equity risk premium is going to run around 3% for the next several years, possibly as long as a decade. I'm not sure it'll be quite that long, but at any rate, right now we're about 2.5%, so it's in the ballpark. But what this says is that when the S&P earnings yield, the red line, is above the blue line, the bond yield, that says that stocks are undervalued relative to bonds. And when you're trying to determine where a better investment is, you kind of want to put some money where you've got some undervalue versus the alternative. And anyone that's watching the bond market knows this is absolutely true right now. So just something to keep in mind. There's a lot of different ways to value the market. Some of them make more sense to think about or at least consider in a low interest rate environment, and this is one of those. Now, talked about earnings recovery. So can an earnings recovery bring down valuations? What we've got here is, the impact of the earnings recovery over the last earnings for 12 months, and what we can see is it's turning up, and that's important. And if we look at the quarterly earnings per share, we can see it's moving up aggressively since 2015. If this trend continues, and it may, then we could have some of this valuation come down kind of organically because earnings are growing. And if valuations don't rise along with earnings, then the valuation comes down, which means there's a little more value in the market. So this is another reason that stocks are perhaps more compelling than bonds at this point, because we are seeing some uptick in growth in S&P earnings right now, maybe a little early, but many sectors are seeing stronger earnings growth than the S&P, and there's some additional value in those sectors. And there's a couple that are really undervalued with the kind of earnings growth they're experiencing versus the way they've been valued in the past. So those are good places to put money, and I'm doing that for my clients. Now, another reason that the market is not really out of control is because growth is still free. And what I mean by that is if you were to decide you're going to put money away for 10 years, you're going to invest it in bonds, or you're going to invest it in the market, even just the S&P, the dividend yield on the S&P 500 is a little over 2%. The 10-year Treasury right now is about 1.6. So when you think about it that way, you're going to get paid more, most likely, almost certainly get paid more to own the S&P over 10 years. And at the end of that 10 years, even if we have an evil bear market in between, and it's very likely we will, the S&P is still probably going to be at least as high as it is today, or close to it, and the probabilities that it will be significantly higher than it is today are pretty good. On the other hand, with bonds, it's very likely that bonds are going to be significantly lower in 10 years. So your best case scenario with bonds is 1.6%. Kind of your worst case scenario with the market would be maybe 2%. So you're going to get paid more to own it, and at the end of 10 years, it's likely you're going to get some capital growth out of it, possibly a lot of capital growth, possibly a little capital growth, but very likely it's going to be there. So that's why I say growth is free. So stepping into the conclusions here, the S&P is overvalued. It's not spectacularly so. Depending on how you want to factor the low interest rate environment and how likely you think that is going to persist, maybe quite a bit less overvalued than it may appear by PE ratios and things like that. We're seeing good earnings growth in a lot of sectors, and if this continues, that's probably going to be a positive catalyst for stocks as we move into the end of the year and into 2017, barring recession. We're beginning to see the energy companies that were hemorrhaging over the last year and a half or so, since 2014. The band-aids are on, they're working, the hemorrhaging is stopping, and I think they're going to contribute to earnings beginning, in the second half of 2016 and moving into 2017, I think. And if that's so, that's kind of a big positive for the market. So we'll see how that plays out. In the meantime, falling oil has absolutely benefited consumer spending. The lag I talked about in January has caught up. 70% of the U.S. economy is driven by consumer spending. So this is a positive for the markets. As the consumer goes, so goes the economy, so goes the market. Currently, the biggest risk is still the Fed. You've heard me talk about this before. I still don't see any aggressive rate raises coming down the pipe. It's just not going to happen. Anything less than a 37.5 basis point raise in the next several months is basically supportive of the markets, as is no raise. So something to kind of keep in mind when you're thinking about what the pundits have to say about things. Lastly, I still have no idea really what the presidential and legislative election cycle is going to do. The impact's uncertain. What I do know is the spending is a positive. And the dollars that are being pumped into the economy for the political ads and TV and all of that are a benefit to the economy. Not huge, but they are a little bit of a tailwind, which is nice to see. I take that back. There is one thing I know about this presidential cycle: worst choices ever. That's all I'm going to say about it. Other than that, I don't know what's going to happen. So thanks. I went a little longer than I meant to. That seems to always be the case. But if you have questions, feel free to send me an email. I try to set aside a little time every week to answer questions from anyone that emails in from all over the country. So happy to do that if you've got a question or a comment. If you're a client and you've got questions, just give me a buzz. You've got my office number. And other than that, thanks again very much. See you next time. Here's the disclosures, and I'm going to cue the theme music that everybody loves so much. Thanks very much.